Welcome to the classroom. Please like, share, and subscribe to our channel.
In the previous video, we spoke about how households own the factors of production, how businesses buy these factors of production and use them to create goods and services, which in turn are bought by households. It's a relationship of input, production or processing, and outputs. Before we delve deeper into the classification of markets, I want to quickly talk about labor markets, the raw materials market, and financial markets. The labor market is a place where workers offer their services so that they may earn salaries or wages. If you have seen people standing on street corners with a sign stating that they will paint, cut trees, or offer any service, that is a labor market. Some of the most formal or common labor markets are career seeker websites. It is sang that certain things in life should be free. However, this is business. Where there is a need, there is money to be made. Raw materials include anything which can be found in the ground, above the ground, and perhaps beyond. Examples of these may include water, the flora and the fauna, minerals such as coal, gold, and others. Then, there is the gold standard, financial markets.
Financial market is a broad term used to describe any forum where buyers and sellers meet to trade assets, usually financial securities such as stocks, bonds, currencies, options, and derivatives. Financial markets are a cornerstone of a capitalistic economy because they help facilitate capital formation and liquidity for entrepreneurs and businesses. Financial markets create liquidity by making it easy for buyers and sellers to trade their financial holdings. Without the infrastructure of a market, sellers would have to seek individual buyers using less efficient methods such as classified ads, much in the same way someone sells a used car. In addition, the centralized location provides transparency for price and availability and better subjects the securities to market forces of supply and demand. This in turn assures buyers and sellers of a fairer price than they might otherwise receive in a single private transaction. Because they are subject to supply and demand forces, financial markets sometimes experience wide volatility due to variables such as the unemployment rate, gross domestic product, and housing prices. In the 20th century and before, financial markets were central locations where traders met and made trades in face-to-face transactions. The New York Stock Exchange is one of the oldest and most famous financial markets in the world that still has face-to-face trading. Other financial markets like the NASDAQ lack a physical trading location. Instead, trades are facilitated via an electronic system.
Markets may be classified according to 4 different criteria: legal versus illegal markets, the place in which markets are situated in, the time frame for which a market is open, and the competition which the market will face. It is good for a country to have a majority of businesses to operate in a legal space. When a country has successful businesses, it may have more money come towards it through taxes. And with these taxes, the lives of everybody in the country may become a little bit more better. Do keep in mind, however, that not all businesses who do not pay taxes are illegal. There are certain laws that do allow for businesses to not pay taxes. That leads me to my question. What do you think would make a business illegal? Markets may be categorized according to the place in which they are based in, or where the business operates. It may be a combination of the following or these factors individually: local, such as the area around you; A national market, meaning that it only operates in your country. An international market, meaning that the business operates all across the world. A virtual market, which means that the market only exists online. Which businesses do you know of which operate in all of these markets? Time will talk about how long a market has existed or plans to stay in operation. Some businesses may only be in operation for a short period of time, such as a week, a day, or maybe less. Some businesses may be in operation for the medium term, which could be any period between 1 to 5 years. There are many varying reasons why certain businesses may stay open for this time frame. Then there is the Magna Carta, businesses which have been operating for the long term. Businesses which survive their first 5 years have a better chance of surviving for a longer time. There are other businesses which have even outlived their founders. Competition talks about how many businesses may exist in a certain industry. Too many businesses in a similar industry isn't the best for the people competing. It'll mean far less profits for everybody involved.
In perfect competition, no single firm controls prices. There are no barriers to entry or exit. All firms sell the same products and services. They all have the same industry knowledge, and there's a large number of suppliers and buyers. If any of these conditions are absent, it's an imperfect competition. Imperfect competition appears in several different forms. In monopolies, only one seller exists. For example, a drug company offering a medicine that has no substitute. In an oligopoly, there are many buyers, but only a few sellers. Smartphones and other high-tech industries are examples of oligopolies. Monopolistic competition exists when many sellers offer similar products from many buyers. Fast food restaurants feature monopolistic competition by creating similar products that are not perfect substitutes. In a monopsony, there are many sellers of a product, but only one buyer. The U.S. defense industry is a monopsony. Many firms create products that they try to sell to the U.S. military. An oligopsony has only a few large buyers for a product. The tobacco industry exemplifies an oligopsony. A handful of large cigarette companies buy almost the entire annual tobacco crop. Realistically, perfect competition is only a theory because every industry has some form of imperfect competition. Markets are valued by how they compare to and try to approach perfect competition.
Thank you for joining us in part 2. Please subscribe, share, and like, and don't forget to turn on our post notifications.